All right, let's talk about something most of us have in our wallets, the credit card. It feels like a little piece of financial magic, doesn't it? You can tap it, swipe it, or insert it. And just like that, you've bought your groceries, a new laptop, or even a vacation you've been dreaming about. It's incredibly convenient, and when you use it correctly, it can be a powerful tool for building your credit score, earning amazing rewards like cashback or free flights, and even protecting your purchases. In many ways, that small piece of plastic can feel like a superpower, giving you the ability to buy now and figure out the payment later. It offers a level of flexibility and security that paying with cash or a debit card simply can't match. But here's the thing about superpowers. They all have a weakness, a kryptonite. For credit cards, that weakness is interest. This is the hidden cost that can turn a simple purchase into a long-term financial burden that weighs you down for years or even decades. The very convenience that makes credit cards so appealing is also what makes them so dangerous if you're not careful. The bank is essentially lending you money on the spot, and they aren't doing it just to be nice. They are in the business of making money, and they do that by charging you a fee, the interest, on any money you haven't paid back by the end of the month. It's a silent cost that grows over time, often without you even noticing until it's become a massive problem. Many people fall into the trap of thinking of their credit limit as their own money. If the bank says you can spend $10,000, it feels like you have an extra $10,000 in your bank account. But that's not the case at all. That limit is a loan, and it's one of the most expensive loans you can possibly get. The credit card companies make it incredibly easy to spend, but deliberately make the consequences a little confusing. They send you a bill with a tiny minimum payment amount, making you feel like you're keeping up with your obligations. In reality, that minimum payment is designed to keep you in debt for as long as humanly possible, maximizing the amount of interest you pay to them. So, this whole discussion is about pulling back the curtain and showing you exactly how this system works. We're going to break down the numbers in a simple way so you can see the real, tangible cost of carrying a balance on your credit card. My goal isn't to scare you away from using credit cards altogether, not at all. It's to arm you with the knowledge you need to use them as the powerful tool they are meant to be, without ever falling victim to their kryptonite. By the end of this, you'll understand how to make the credit card companies work for you, not the other way around. Let's get into it. Before we dive into the big, scary numbers, we need to get on the same page with a few key terms. Think of this as learning the basic rules of the game. First up is the balance. This is simply the total amount of money you owe on your credit card at any given time. If you buy a coffee for $5 and a new TV for $500, your balance is now $505. It's the running tab of everything you've charged to the card that you haven't yet paid back. Keeping track of your balance is the first and most important step in managing your credit responsibly. It's the number you need to get to zero every single month if you want to avoid paying extra. Next, let's talk about the minimum payment. When you get your credit card bill, you'll see this small amount listed. It's the absolute least amount of money the credit card company requires you to pay for that month to keep your account in good standing. This is usually calculated as a small percentage of your total balance, often just 1 or 2%, plus any interest and fees. While paying the minimum prevents you from getting a late fee, it's a trap. It's designed to do the bare minimum to reduce your debt, meaning the vast majority of your payment gets eaten up by interest charges and your actual balance barely goes down at all. It's the financial equivalent of trying to bail out a sinking boat with a teaspoon. Now for the most important term of all, interest, often shown as the annual percentage rate, or APR. This is the price you pay for the convenience of borrowing money from the credit card company. If your card has an 18% APR, it means the bank is charging you an 18% fee per year on any money you owe them. This interest is usually calculated daily and added to your balance every month, a process called compounding. This means you end up paying interest on your original purchases, and you also start paying interest on the interest that has already been added. It's a snowball effect that can quickly turn a small debt into an unmanageable mountain. Finally, you might hear the term prime rate. This is an interest rate that big banks charge their most creditworthy customers. Why does this matter to you? Because many credit card APRs are variable, meaning they can change over time. Their rate is often set as the prime rate plus a certain margin, like prime plus 15%. So when you hear on the news that the Federal Reserve is raising interest rates, the prime rate goes up, and soon after, your credit card's APR will likely go up too. This makes your existing debt even more expensive to pay off, without you having done anything at all. Understanding these simple terms is the foundation for mastering your finances. Let's get into a real-world example. Imagine you've racked up a $5,000 balance on a credit card. Maybe it was for a well-deserved vacation, some necessary home repairs, or maybe it just slowly built up over time from a lot of smaller purchases. Now your bill arrives and you see that your minimum payment is only about $100. At first glance, that might seem manageable. You think, okay, I can handle $100 a month. It feels like you're making progress and being responsible by paying your bill. But what you don't immediately see is the disaster that is slowly building behind the scenes. Let's assume your card has a pretty standard APR of 21%. In the very first month, the interest charge alone would be about $87.50. That means out of your $100 payment, only a tiny $12.50 actually goes toward paying down your original $5,000 debt. The other 87.5% of your payment just vanishes into the bank's pocket as pure profit. The next month, your balance is now $4,987.50. You make another $100 payment, but the interest is still incredibly high. This cycle continues month after month, with you feeling like you're chipping away at the debt, when in reality, you're mostly just paying the bank for the privilege of being in debt. So, what's the final damage report? If you stick to only making the minimum payment on that $5,000 balance, you will be stuck in debt for an incredibly long time. How long? You're looking at over 17 years to finally pay it off. That's 208 monthly payments. And the total cost is even more shocking. Over those 17 plus years, you would end up paying a staggering total of around $10,400. Let that sink in. You bought $5,000 worth of goods or services, but you paid more than double that amount. You paid the bank an extra $5,400 in interest, which is more than the original amount you spent. This is the minimum payment trap in action. The credit card company presents you with an easy, low-cost option that seems affordable in the short term. But this path is designed to be the longest and most expensive route possible. That $5,400 in interest is money that could have gone toward your retirement, a down payment on a house, an investment, or literally anything else. Instead, it was completely vaporized, paid for something you bought nearly 2 decades earlier. It's a silent financial drain that robs you of your future wealth, one small minimum payment at a time. It's a terrible deal, and it's one that millions of people unknowingly accept every month. Now let's take that same scenario and make it even more serious. Let's say your balance isn't $5,000, but has climbed to $10,000. This is a situation many people find themselves in, whether from a major life event like a medical emergency, a period of unemployment, or simply from consistent overspending that snowballed over a few years. With a $10,000 balance, the credit card company will once again offer you what seems like a simple way out, a minimum payment. This payment would be around $200 a month to start. Again, it might feel like a stretch, but perhaps a manageable one. But the financial devastation is twice as bad. Using the same 21% APR, let's do the math for the first month. The interest charge on a $10,000 balance is a massive $175. This means that when you make your $200 minimum payment, a full 87.5% of it goes directly to the bank as interest. Only a measly $25 actually goes toward reducing your $10,000 debt. Your new balance is $9,975. You've just handed over $200 and your debt has barely budged. This is an even deeper hole to climb out of, and the minimum payment is like a tiny, flimsy ladder that's about to break. It gives you the illusion of progress while keeping you firmly stuck in debt. So how long would it take to escape this $10,000 debt prison by only making minimum payments? The answer is absolutely horrifying. You would be making payments for more than 28 years. That's almost 340 payments. Think about that for a moment. You could have a child, raise them, and send them off to college, and you would still be paying for that stuff you bought almost 3 decades earlier. It is a financial life sentence that quietly follows you through every stage of your adult life. It's a constant weight on your shoulders, month after month, year after year. And the total cost? It's almost unbelievable. To pay off that $10,000 balance with minimum payments, you would ultimately pay a total of around $20,800. That means you paid an extra $10,800 in interest. You paid more in interest than the entire original amount of the debt. You essentially bought everything twice, once for yourself and once for the bank. That extra $10,800 could have been a new car, a significant chunk of a down payment on a home, or a powerful boost to your retirement savings. Instead, it's just gone, evaporated into thin air, all because of the slow, grinding trap of minimum payments. Sometimes, just hearing the numbers isn't enough to fully grasp the severity of the situation. We need to see it. Let's visualize the journey of paying off that $5,000 debt. Imagine a simple bar graph. On one side, you have a bar representing the value of what you bought, $5,000. This could be a fantastic trip with friends or family, a new set of furniture for your apartment, whatever it was. That value is fixed. The memories are great, and the furniture is useful, but its monetary value was $5,000. On the other side of the graph, we have a bar representing the total amount you paid. As we saw, that bar climbs and climbs until it reaches $10,400. When you look at those two bars side by side, the reality is, stark and unavoidable. The bar for your total payments is more than twice as tall as the bar for the value you received. For every dollar of value you got, you gave the bank more than $2. It's a visual representation of a terrible deal. You wouldn't walk into a store and agree to pay $10 for a coffee, so why would you agree to a deal where you ultimately pay $10,400 for something that was only worth $5,000? Yet, this is exactly what happens when you fall into the minimum payment trap. It's a slow-motion transaction that hides its true cost over many years. Now let's create the same graph for the $10,000 balance scenario. The value received bar sits at a solid $10,000. This might represent a used car, a small business startup cost, or a combination of many large expenses. It's a significant amount of value. But the total paid bar, after those 28 long years of minimum payments, skyrockets to a massive $20,800. Once again, the bar representing your payments is more than double the height of the bar representing what you actually got. It's an even more extreme version of the same bad deal, a financial hole that just gets deeper and deeper. These graphs make it painfully clear. When you carry a credit card balance, you are agreeing to pay a price far higher than what's listed on the price tag. The interest payments become a product in themselves, an expensive, invisible product you didn't want but are forced to buy every single month. Over time, you end up spending far more money servicing the debt than you did on the original items. This visual evidence cuts through all the complex financial jargon and shows the simple, brutal truth. You are paying way too much, and the only one winning in this scenario is the bank. Let's explore an even more extreme, yet sadly common scenario. What happens if someone doesn't just carry a balance for a while, but essentially lives with their credit card maxed out for the long haul? Imagine a person who has a $10,000 credit limit and keeps their balance right around that $10,000 mark for 20 straight years. They use the card for expenses, and as they pay it down a little bit with the minimum payment, they charge it right back up. They are essentially treading water, never getting ahead and never paying it off. They are stuck in a state of perpetual debt. For 2 decades, this person makes the minimum payment every single month. Let's say that payment averages out to be around $200 per month. So, over the course of 20 years, how much have they paid? Well, $200 per month multiplied by 12 months in a year is $2,400 per year. And $2,400 per year multiplied by 20 years is a grand total of $48,000. That's right. Over 20 years, they have shelled out nearly $50,000 in payments. It's just an enormous amount of money, paid out in small, seemingly manageable chunks that added up to a fortune over time. But here's the most devastating part of this story. After paying $48,000 over 20 years, how much do they owe? They still owe the full $10,000 because they were only ever covering the interest and a tiny bit of principal, which they then spent again. The balance never actually went down. They are in the exact same financial position they were in 20 years ago, except they are now 20 years older and have $48,000 less in their net worth. They have spent the equivalent of a brand new luxury car or a down payment on a house and have received absolutely nothing to show for it in the end. This is the ultimate trap of high-interest debt. It creates a cycle that is incredibly difficult to break. You work hard to earn money, you use that money to make your credit card payment, but that payment just evaporates into interest, leaving the core problem, the debt itself, completely untouched. It is a financial hamster wheel, where you run and run as fast as you can, but you never actually go anywhere. This is why credit card companies love customers who carry a balance. Those customers provide a steady, reliable stream of pure profit for decades on end, funded by their own financial stagnation. It's time for a reality check. We need to directly compare what you paid with what you actually got. In our $5,000 example, you received $5,000 worth of goods, services, or experiences. That's the real value. But the real cost wasn't $5,000. The real cost was $10,400, and over 17 years of your life spent making payments. You effectively paid an extra $5,400 for nothing. That extra money is the price of procrastination, the cost of not paying the balance in full. Think about what that $5,400 could have done for you if it had been invested in the stock market over those 17 years. It could have grown into a much larger sum, building your wealth instead of the bank's. Let's do the same for the $10,000 example. The real value you received was $10,000. The real cost was $20,800 and 28 years of your life chained to that debt. The difference, a painful $10,800, was pure profit for the credit card issuer. Now, let's talk about those credit card rewards that everyone loves. People get excited about earning 1% or 2% cash back. On a $10,000 spend, 2% cash back is $200. That feels great. But if you carry that balance and end up paying $10,800 in interest, that $200 you earned is completely wiped out. In fact, you're still in the hole for $10,600. The bank is happy to give you a $200 reward if they know they can get over $10,000 back from you in interest. The value proposition of credit card rewards is completely dependent on you paying your balance in full every single month. If you don't, the math flips and it becomes the worst financial deal imaginable. The rewards points, the cash back, the free travel, all of it is bait. It's designed to encourage you to spend more on the card. The credit card companies know that a certain percentage of people won't be able to pay it all back at the end of the month. Those are the people who fund the entire rewards program for everyone else, and then some. Don't be one of those people. So when you're thinking about making a large purchase on a credit card that you know you can't pay off right away, you have to ignore the rewards. The rewards are irrelevant. The only number that matters is the APR. You have to ask yourself, is this item worth 21% more than its sticker price? Is it worth double its sticker price? Because that is the true cost you will likely end up paying. When you frame it that way, the decision becomes much clearer. Suddenly, waiting and saving up the cash to buy it outright sounds like a much, much smarter idea. After all this doom and gloom, I want to be perfectly clear. I am not against credit cards. In fact, I think they are a fantastic financial tool when, and only when, you use them correctly. The secret to winning the credit card game is incredibly simple, and it comes down to just one golden rule. Pay your balance in full, on time, every single month. If you do this, you transform the credit card from a dangerous weapon pointed at your own finances into a powerful tool that works for you. You get all of the benefits with absolutely none of the terrifying downsides we've been talking about. When you pay your entire statement balance by the due date, the amount of interest you pay is zero. That's right, a big fat zero. The 21% APR becomes completely irrelevant. It could be 100% APR for all you care, because it will never apply to you. You are essentially getting a free short-term loan from the bank for about 30 days on every purchase you make. You get the convenience of tapping to pay, the security of fraud protection, and a detailed record of all your spending, all for free. This is how financially savvy people use credit. They treat their credit card like a debit card, never spending money they don't actually have in their bank account. This is also where the rewards actually become valuable. When you're paying no interest, that 2% cashback is pure profit. Those airline miles are genuinely free flights. The sign-up bonuses are free money. You are effectively getting a discount on everything you buy, paid for by the bank. You are hacking the system to your advantage. The credit card companies are still making money from the transaction fees they charge the merchants, so don't feel too bad for them. But you are no longer the source of their massive interest profits. You are now the one who is reaping the benefits of the system. Building a positive credit history is another huge benefit of using a credit card responsibly. By making consistent, on-time payments, you show lenders that you are a reliable borrower. This leads to a higher credit score, which is one of the most valuable financial assets you can have. A high credit score unlocks lower interest rates on the most important loans you'll ever get. like a mortgage for a house or a loan for a car. The few $100s you earn in cash back is nice, but saving tens of thousands of dollars on your mortgage interest over 30 years is life-changing. And it all starts with the simple habit of paying your credit card bill in full every month. So, we've been on quite a journey. We've seen how a simple $5,000 purchase can balloon into a $10,400 payment over 17 years, and how a $10,000 balance can become a 28-year, $20,800 nightmare. We've visualized the damage and seen how the cost you pay can dwarf the value you actually received. The single most important takeaway from all of this should be a healthy dose of caution and respect for the power of credit. A credit card is not free money. It is a tool, and like any tool, it can be used to build something wonderful or to cause a lot of damage. The choice is entirely up to you. The path to financial health isn't about cutting up your cards and living in a cave. It's about being intentional. It's about understanding the rules of the game so you can play it to win. Before you swipe that card, ask yourself a simple question. Do I have the cash in my bank account right now to pay for this? If the answer is yes, then go ahead and use the card to get the points and protections. If the answer is no, then you need to stop and think very carefully. Is this purchase worth paying double for? Is it worth being in debt for years? In almost every case, the answer will be a resounding no. The freedom that comes from having no high-interest consumer debt is priceless. It's the freedom to make choices about your life and career based on what you want, not on what you need to do to make your minimum payments. It's the peace of mind that comes from knowing that your money is working for you, building your future instead of just enriching a bank. Escaping the minimum payment trap, or better yet, never falling into it in the first place, is one of the most powerful steps you can take toward building real, lasting wealth. It's about taking control of your financial destiny. My hope is that this breakdown has empowered you with knowledge. Use your credit cards, enjoy the rewards, and build your credit score. But do it smartly. Do it with a plan. Always, always pay the balance in full. Treat your credit limit as a safety net, not a target. By adopting this one simple habit, you ensure that the plastic in your wallet remains a superpower that serves you, and you will never have to worry about its kryptonite. Thank you so much for reading, and here's to your financial success.